Well, welcome to our class today. And here in auditing, we're going to be studying chapters 14, 16, and 23 altogether. So what we're doing is studying the sales and collection cycle. So everything involved in selling goods and services to customers, then collecting money from them. So that's why we'll also study accounts receivable here in just a bit in chapter 16 and cash in chapter 23. Because after all, if we do sell goods and services to customers, we hope that they eventually turn into cash. Unfortunately, though, not all will. So we'll study bad debts expense along the way as well. So what I would like to do is to start off on chapter 14 with you. Let me go ahead and share my screen. So the sales and collection cycle. We're going to review the functions of documents that go into the cycle, and that should be a review of AIS. We'll approach it from more of an auditing standpoint. Then we will be going through some internal controls we hope to see, and some substantive tests of transactions, and we'll see how the auditor will put these together in an audit program. So in chapter 14, we're going to study individual transactions themselves, and we'll see substantive tests of those transactions and tests of details involving those transactions. Because after all, with both a test of control and a substantive test of transactions, we do one transaction at a time in general. So guess who on the audit team gets to do that? Yeah, exactly. It's grunt work. Junior gets to do it for the most part. So we'll say some about those. But in chapter 16, well, we'll primarily look at substantive tests for accounts receivable there. So in chapter 14, that means there we're dealing with individual transactions, again, looking at the internal control over each and doing substantive tests of those transactions to make sure the right amount of dollars will be there. So it's kind of a stair-step projection we have. We first go into chapter 14, then 16, then 23. I think it will make sense. Also, a lot of this material is going to be a review of accounting information systems. So some things may be called slightly different things, although some will be almost verbatim out of accounting information systems. So I think it's good to see the AIS information here in auditing as well, because it shows how auditors tend to apply it. Sometimes in accounting information systems, we get terminology and ideas which are left over from mainframe computers, which aren't very user-friendly to accountants. But over the years, accounting, as well as all other disciplines, has been addressed more and more by specialized software. So we don't have to go with generic software anymore, and therefore, maybe mess something up here in the test we're going to do in the sales and collection cycle. So with that in mind, first thing I'd like to do is to look at Roman numeral 1. We're going to review the cycle, and figure 14.2 on page 447 reviews the accounts involved in their interrelationships. So let me go ahead and take a look at that over here. Excuse me. Periodically change up a little bit. Now professors can get in. Here we go. Come on, in we go. Is Wi-Fi ever slow for you here? Always. Okay. Now we're making a little bit of progress. I say a little bit. Come on, don't strain yourself there. Okay, slowly but surely. Yeah, and I don't know why they did this. I have all these images for the same book. Go figure. Here we go. Here's the figure I'm talking about here. So the figure here on page 447 says accounts of the sales and collection cycle. They're all going to look extremely familiar. Right here, they have accounts receivable and harvest. Because if a company sells to customers using its own in-house credits, then obviously what we expect to be influenced most is going to be sales revenue. And in turn, accounts receivable. So this assumes they're not going to an outside credit card processor where the customer comes in, charges via MasterCard, Visa, American Express, Discover. It's still out there, isn't it? Okay, I think. Well, so our own in-house credit. Therefore, we have to account for those accounts receivable personally and also take care of bad debts expense on our own. I bring this up because a lot of companies simply rely on an external credit card processor to go ahead and do everything, including collecting cash. Well, we're not talking about using MasterCard, Visa, American Express again. We're talking about companies' own in-house credits. So that's always assumed here. Whenever you see accounts receivable in general in accounting. So as we look here, well, accounts receivable in the middle of it, it's an asset, so a normal debit balance. We see what increases accounts receivable on the credit or left-hand side. That's going to be sales on account, obviously not for cash. And over there on the right-hand side, I call it interrupted, please stay up. So as we look there, well, there was a cash receipt. I don't know what that was about. Store returns and also allowances, because those are contra revenue accounts. They will reduce accounts receivable. And, we talked about those deadbeats. Well, write-off of uncollectible accounts receivable. Obviously, of those three credits to reduce accounts receivable, the biggest one that we're going to have there will be cash receipts. So if someone pays their account off, we debit cash and we credit accounts receivable. We see the accounts receivable, in addition to relating to sales revenue, it's also going to relate to cash in the bank. That's where we deposit how much we take in. We see cash discounts taken. Those are terms like 210 net 30. So the company gets, or the individual customer gets, a 2% discount in that case for paying within 10 days. And we have another contra sales revenue account there, sales returns and allowances. Then for those accounts receivable, they're using the aging method, just reading between the lines. So we have the allowance for uncollectible accounts, which we did increase at the time, hopefully, we did our last aged trial balance of accounts receivable. Then we do have to estimate bad debts expense in advance, and that in turn affects the bad debts expense. So when you think about it, they're resting on accounts receivable. Almost all of those did either debit or credit accounts receivable. And by the time that the individual customer gets over to accounts receivable, well, sometimes when an individual customer gets to the place where they're billed for accounts receivable, again, what do some deadbeats say? Let me make myself scarce. Yeah, so more about that later. Some people kind of do that as a way of life. Sure that this is going okay. Good, it is. Yeah, it's very annoying when you're not sure if it's recording okay, especially because in the classrooms, we get bounced a lot. We really do. So then you wonder if you're going to let back in by Zoom or not. So you always need to double check. I hate to cut off most of the rest of class, the students, but I'm just going to re-record it. So as we come back here to our handouts, again for 14, 16, and 23, well, in B, we can remember that the term cash includes not only currency, I mean, that's what people think it is in general, and it does, but it also will include demand deposits, such as a checking account. Generally, in fact, for any type of cash equivalence where it's going to be turned into cash in 90 days or less, that would even include, for example, a certificate of deposit that is for 2 years, but it's going to be reclassified from a long-term asset to a current asset when that repayment is going to be paid off by the bank. If it's within 90 days, that can be reclassified as cash. And that's very helpful action to companies. After all, what would you rather show? Would you rather show a certificate of deposit in the bank, or would you rather show? Yeah, you'd rather show cash. Because even though in 90-day from maturity, certificate of deposit is really good cash equivalent. Well, still, every business, first two, would like to show more cash. That's just the nature of the beast. But if that certificate of deposit or some other type of cash equivalent is not going to be paid to the company, our client that is, within 90 days, then it needs to be left as a current investment. If it's going to be paid in more than 90 days, then it needs to be which type of investment? And I'm sorry, I said that wrong. If it's going to be paid in more than a year, then it should be a long-term investment. But oftentimes, as that repayment date gets closer, and this thing actually flips from a long-term investment to a short-term investment or current investment, like companies often forget to make that flip on the books. So they need to classify that on balance sheet as a long-term asset, even though it's due in less than a year. And again, it's due within 90 days. They have every right just throw it on in cash. That's just kind of a nice little perk there. Now, and see, the functions and related documents in the cycle are described on pages 449 through 52. And I'd like to walk through these pages. And these functions and documents are also covered in accounting information systems, sometimes with a slightly different name, but they are covered there too. So we approach things here from an auditing standpoint, so things will be a little bit different. Oh, and Antoine, I see your email there, so good.
Yep, I'm in here
They're all
now.
taken care of now, right? So let me go ahead and turn to page 449 in our book. So this information you probably had an AIS. Pretty sure you did, even if you took it in another school. And nobody has not had AIS, correct? Okay. I mean, it wouldn't matter if you hadn't had, from my standpoint, because I could still cover the material just fine. But again, one reason that we do have some AIS in this course is that this course could double count for a transfer student that we get who has not had AIS. And there are still some schools that do that. It's not as common as it used to be, thank heavens, but well, we have all of our bases covered. So what we do, well, the very first thing that kicks everything off is that we need to process customer order. So a customer comes to us, they say they want to order something, or they mail us a paper order form, the old days, or they may engage in electronic commerce instead. We hope they do. So, processing a customer order. Well, what this company is going to do is transform that into an internal document. And I'll show you how it does. So we see there in the book that a customer's request for goods initiates the entire cycle. So what does it take to sell someone a good or service? They have to let us know. And we see that that customer order is going to be a request for merchandise by the customer. Sure enough. So probably easiest way to think about it, if you are in an electronic system, is where you're ordering something. So you're filling out some type of test word. And like I said, it used to be that companies had order blanks in the catalogs, just right there waiting for you to tear out. Do some catalogs, yeah, I guess some catalogs still do have these customer order forms, don't they? Tear out. I mean, I haven't ordered out a catalog in a long time. Sure, I've ordered things online, but I just go directly to the customer order form online. By the way, those are designed so they're very, hopefully, relatively few errors. That's hopefully the app takes care of it. So what usually happens here is then, well, that customer order, it may have problems because we cannot rely on an individual customer to have that order correct. Sometimes we find things wrong. So that's why within business, we transform that customer order into a sales order. The sales order is right. It has the proper item numbers, the proper description of each item. Coffee fix the way that you would like, almost. Well, no. Well, some companies do resort to that. I think out here for Southern, did they ever fly you with things like coffee, nice tea, like a reception, admissions reception? Fly you with things like iced tea, cookies. Oh, okay. Oh, okay. Yeah, one to receptions in other cities, they offer stuff like that. So that's what we cookies, tea, things like that. Easily convinced, huh? But the sales order, if you are ordering online, is going to be your second screen. Your first screen, where you fill in the information, including your credit card number, is customer order. Then once you get all this filled out, you'll press the submit button. If there are no issues, then that order is going to go through. It's going to be transformed into a sales order. So that sales order should be pretty darn perfect, including showing the credit approval. If something is wrong, you press that submit button, and then what you get back. Does your order go on through at that point? No. So you're going to get an error message. So if something's wrong, including very commonly, the credit card's expired or limit, or the customer didn't order the correct numerals, things like that. But that computer checks everything over, if you will, as it generates that internal sales order. So the customer order is from the outside, it's translated into the sales order, which is the internal document. Now, the next thing, the next function is grant credit. Well, I just mentioned grant credit, but as we step back and think about that a little bit further, in a manual system, grant credit to a customer, someone in the credit office would check their credit records, make sure that they're not dead, make sure they're not behind or over the limits. And that's different than a computer doing today. I should say they accomplish the same thing, but the computer certainly does do it a lot faster. Again, credit is granted automatically by the computer if everything you enter is okay. You certainly have to be very careful, though, about granting credit If credit is not properly granted, well, yeah, a lot of deadbeats come in the system. They don't pay. That debt's expense is going to go away. And sure don't want that. Now, next thing we're going to do is shipping goods. So it's time to ship things out. How careful do you think you need to be with internal control? Extremely. Because you could be goods for inventory. And the customer should get. So price spread wasn't very obviously they should not get the goods. So very, very careful about the point at which inventory is released, because otherwise it could get released to a customer again whose credit is not deserving of it. It could get released to an employee. I think I mentioned before that think about an individual employee in many businesses being able to load up back to the loading dock, back up a pickup truck and get a whole bunch of merchandise, whereas an individual customer might get by with one or two items out front. But that's why the average take by an employee is about 6 times what the average retail theft by an individual customer is. Guess who gets to pay for all this in the end? Yeah, we do. So let's look here at this little paragraph here with shipping goods, or at least first couple of sentences. So this critical function is first point in the cycle which the company transfers ownership of assets. Most companies recognize sales when goods are shipped. Shipping documents prepared at the time of shipment, which can be done automatically by computer based on the sales order information. The shipping document, which is oftentimes a multi-copy bill of lading, is essential to proper billing of shipments to customers. And companies that maintain perpetual inventory records also update them based on shipping records. In fact, as we are at a store, and items are being scanned by the barcode, yes, that's update perpetual inventory records. Well, cashiers do that, but increasingly gets to do that function. Scan it. Yeah, we do. So increasingly, that little function is being pushed to us. So another cost-cutting feature, especially after the pandemic. But that's okay, I guess, except I will say that unfortunately a lot of cashiers are out of work because of that. And would you say that being a cashier is going to be a very good growth prospect career? No. Technology is replacing a lot of people, and cashiers will be out there on the front lines of it. But in the case of shipping goods, well, in a retail store, when the cashier or you scans those goods, once they're rung up and your credit's approved or you pay cash, you get a receipt, then you can take them out the door. Let's look here at a document called a shipping document. So a shipping document simply shows what's been shipped. Now, in our book, as well as in most companies, that shipping document contains all the information. So the customer name, item descriptions, quantities, credit approval, all those good things. It may just be a copy of the sales invoice, which is billed to the customer, but your book, and still in practice, will still tend to separate the shipping document, also known as bill of lading, by the way, from anything else. So from a sales order in this case, from sales invoice to bill versus simply a shipping document in its pure form would simply show what's been shipped. So whenever you see shipping documents, you can go ahead and think sales invoice there. The old lady, that's okay. And we see here in this last paragraph that they kind of sum this up well. Well, in an electronic system, tells us there that the bill of lading is often transmitted electronically. Once goods have been shipped, it automatically generates the related sales invoice as well as the entry in the sales journal. So there's the book for original entry for sales. We see that many companies use barcodes and handheld computers to record removal of inventory from the warehouse, just like we scan barcodes again at the cash register. This information is used to update the perpetual inventory records. So certainly every time you scan an item at Walmart, as you buy it, that takes that out of their perpetual inventory. And Walmart only hopes, by the way, that the perpetual inventory master file, which is keeping a running track of what the inventory should be, they hope it matches up to the physical inventory count. But not necessarily, because in addition to clerical errors, what may have happened to some of those items that, well, they did come out of inventory, but they hadn't been recorded in the perpetual inventory master file is doing so. Why do you think probably happens? Almost all. Yeah, that's exactly it. Theft. To be honest, that's another reason why brick and mortar retailers increasingly prefer to ship goods to you, even if they work out a deal with you, free shipping. If you join Walmart Plus, otherwise free shipping at over $35. Well, yeah, they are not only controlling what you buy, and well, we want it in stock, we'll buy it for you, but they're also there making sure that no one else, like another retailer, is going to come in. By the way, Publix does this concept all the time. It will sometimes over-invest in a specific area. And it's done that in some cities. In fact, I argue some here late. The Publix maintain their sales as very much decided to do that. And the one store they're really trying to keep down the area is which one? Okay, well, yeah, you're right. That's right. For your jokes. And Kroger. Several years ago, it's like 12, 13 years ago or so, when Albertsons pulled out for it. Does anybody remember Albertsons? Yes. It's on West, yeah. They pulled out for it, and Publix garnered its sales. Why? Most Albertsons locations. They did that because they thought those empty locations were going to be a really good magnet for growth. Done a pretty good job. Competition out, except for Kroger's trucks. Now, I haven't seen their delivery trucks anymore. Are they still going around?
Yeah.
Oh, okay. Yeah, because I used to see them all the time. Yeah, see one. Sorry,
She orders.
I guess their food's good.
Price.
Yeah, I mean, back over North Miami. Kroger stores, some are nice. They call a lot of Kroger marketplace or something like that. But then the basic Kroger store, pretty slow. Pardon?
The basic one for the pros. We had a really nice one growing up. University of Kentucky on campus.
Okay. That's right, they did. They've taken over a lot of other chains as well. And recently. Anyway, they took over a lot of small chains. Oh, a small chain. They took over that. And so even though store carries the original name, you'll see Kroger brand merchandise in there. Yeah, Delta from. Yeah, Kroger, they just never did much more. Yeah, they're not like, it's not like. No. So we've got that inventory removed from professional inventory. Inventory as customer bought. We report the sale, sales journal. We calculate cost of goods sold based on what they purchased. We hope that we're using, again, professional inventory here a whole lot better than using periodic inventory where you have to rely on account commercial. By the way, even though the store is using the professional inventory system, so they know how much should be in stock at any time. And what's actually in stock is usually somewhat less, clerical errors, and certainly, but there's still accounts because you have to make sure professional inventory master files are up to date. In fact, in lots of retailers, including most department stores, they count inventory at least 4 times every quarter. So it's common way that a department store is count half the store every quarter. So the entire store gets counted twice a year. That way, it's trying to update as closely as possible for real time. Any adjustments that need to be made for inventory can usually find those adjustments. So we've got that shipping document there. And if we look there at the next function, billing customers and recording sales. And if we look there at that first paragraph, they sum it up there pretty well for us, I think. So it says, because billing customers is the means by which the customer is informed of the amount due for the goods, it must be done correctly and on a timely basis. So it's done correctly. That means that in this case, we're very precise. We're fulfilling the accuracy objective in audit. If you remember audit objectives and management assertions, that's accuracy. And if you don't, if you're a little bit rusty, make sure you brush up on those by the time you take the CPA exam. You know, that list I'm talking about from way back in chapter 6. Now make sure you brush up on those because those are such basic terms for the audit. So precision was one objective we like to fulfill. And we see it also needs to be done on a timely basis. That fulfills the objective of timeliness. Now, in the middle of the year, it doesn't really matter too much if you don't record the sale on the actual day it took place. But at what time of the year is it really going to matter? Year end. Because if you don't record that sale on the day it took place, you'll start misclassifying it into the wrong year. You'll misclassify a 2022 sale as a 2023 sale instead, or vice versa. So we'll study more about proper procedures later, but it just means hold the books open and make sure you tell employees at year end to only credit sales on the date they took place. You can get a little bit sloppy in the middle of the year, but not right now. Well, the important aspects of billing. We see that all shipments have been billed, and that's for the completeness objective, making sure we have not understated our bills. You may recall from back in the first auditing course, the completeness says there are no understatements. And the opposite is going to be existence or occurrence. So there were no shipments been billed more than once for occurrence. That way, we make sure that there are no duplicate bills, and that second bill sent to the customer, if it's in duplicate, would violate existence or occurrence. It would overstate our bills. And I bring that up because customers like to be billed too often. No, they're going to get upset. So, and they'll think, what's into this company trying to get my money from me at all times? Then we see something else is each one's billed for the proper amount, accuracy. So again, the precise amount of dollars will be there. And then just under that, we see billing the proper amount is dependent on charging the customer for the quantity shipped at the authorized price, which includes consideration for freight charges, insurance, and terms of payment. So remember, freight in, freight out, that's what they're talking about there. Then something else will prepare a sales invoice. That's your bill. So a simple sales invoice is a register. So if you scan items at Walmart, you'll look on the receipt. That's actually sales invoice. Sales invoice as well. If those items are being loaded onto a truck to bring to you, we might say it's a bill of lading too, just showing what's been loaded on the truck. That's accurate, all those good things, of course. But that sales invoice, one thing that it does mention in the book is that that sales invoice is going to contain all details on it. So authorization to ship, authorization of print, proper item descriptions, proper quantities, proper extensions, meaning price times quantity. So everything on there is good to go. Then something else your book has is a sales transaction file. Well, more commonly, we would say a sales journal. But here's the trick. The reason the book uses that term is because they're referring to a relational accounting database. So in that relational accounting database, it just doesn't keep or store transactions in the same format as a sales journal. The computer doesn't think that way. So it stores transactions in a file, this file of transactions. But then if the user would like to query that database and generate a sales journal in traditional form, well, relational database people do this. That's why they have to mention that there. I'm sorry, what's an example of that? So what happens is really just simplicity of sales. And they'll tell in there like the customer need, the trust, the authorization, credit. Certainly the computer. But a relational database, opposed to a regular database, is the relational database will have sections devoted to certain things like this sales, and will have a number of attributes that are attached to each of those transactions. So that as a user, you can pull up any attribute you want. So if you would like to pull up attributes for it, or I should say sales, or anyone living in this zip code 338 like the format is nice, neat sales journal. So it's more adaptable, more able to be queried than just a kind of shell. Question so far, right? Okay. So got that. We've got the sales invoice. We've got a sales transaction file, relational database, just a listing of all transactions. But then once again, well, we all know and love the sales journal from back in financial accounting. So you can always query that relational database, at least a good one, and pull up the traditional sales journal. Well, then here's another relational database term, accounts receivable master file. More commonly, we're going to call that accounting the accounts receivable subsidiary. That's probably a good thing that they're using an additional term. That way, I'm not quite sure about which term it's going to use on the CPA exam. Or like Egypt. And CPA exam, if something's called one thing in class and then something else different on the CPA exam, like journal in class on the CPA exam master file, fix one, half dozen of another. But if you see unfamiliar terms, what would you start thinking right away? I don't know what we're talking about. Not good under test pressure. So we know that is a listing of each customer's account, all their transactions, and how much they owe. Then the accounts receivable trial balance. Again, we know what that is. That's just where we list every single balance in that accounts receivable subsidiary ledger. And we make sure that the total of the subsidiary ledger, in other words, the sum of all customers' individual accounts, agrees with the accounts receivable master file total. And the company should be doing that periodically for internal verification. If heaven forbid they don't, they could be letting problems go on. I know in theory, yes, the company should be conducting that internal verification process, means somebody's checking over everything can. Does every company do that? No, they don't, or at least not on a consistent basis. Even big companies that should know better often don't do those things on a consistent basis. And that just weakens internal control. That's called an operational efficiency and internal control, call that term. And it's induced by those that are conducting the day-to-day operations. So internal control may be designed just fine. There are no design problems with it. But even the best designed system internal control means how much if employees are not carrying it out on a day-to-day basis. Yeah, doesn't mean anything. All under is really disheartening. Go out to a company and see it. That it happens. It really does. That guy did worse during the pandemic, by the way. Auditors definitely found a lot more problems with internal control, especially in the operational capacity of internal control. People weren't doing their jobs sometimes. And that was also prompted by this fact. How long can companies keep employees sometimes? Not very. By the way, if you would like to get a handle on bad debts expense, What do you do with the trial balance? You age it. The older the account is, the less likely it is to be collected. Then we see monthly statement. We know just what that is. That's the bill sent to every customer, hopefully every month. And owners like to see your send. Quite frankly, with an order, well, bear this in mind. If that individual account balance is overstated, what's that customer going to do? So that statement shows an overstated balance of that customer. What will the customer be upset? Yeah. Will some scream and holler? Yeah. Good structure with my guess. I just need to reverse some together and more. So, yeah, we overstay our bills, trouble we get. The other hand, let's say the company understated the balance. Sent that to a customer. What's that customer going to think? Now they'll think it's my lucky day. I feel like I was charged less than I should have been. So, monthly statements tend to find overstatements of accounts receivable balances. And that's just what the audit is concerned with, because management's motivation is to artificially inflate accounts receivable. Quite frankly. Management has no motivation to understate accounts receivable unless it is a true honest error. But overstating accounts receivable balances, sure, if management could get away with that, they would love to. Now, next thing we have here is processing and recording cash receipts. Well, when we open, let me pick on a manual system first. So for a manual system, hopefully this company has a mail. And that mail room is secured. Employees are observed, they're bonded, like insurance for the background been checked out, so trustworthy, et cetera, et cetera, et cetera. Well, that's costly to maintain, so we'll talk about alternatives in a second. But in that mail, here come the envelopes. And inside the envelope should be two things. One, of course, should be the check or money. The other thing should be in there is one is called the remittance advice. That's the part of your credit card statement you can send with your payment. So cashier compares the amount of the remittance advice, the check, and just a moment, those two things are combined. After that, they will be separated. So the pile remittance advice, which shows customer name, account number, etc. That stack is going to go to be recorded in books. So we'll go under the controller or someone under that control. On the other hand, the stack of checks plus money orders will go over to the treasurer in some capacity. Maybe a cashier serves under the treasurer. Because you may recall back and only one, we never want to combine custody of an asset with accounting for the asset. Because otherwise someone could just cover up something that's wrong, include that in the books, and everything would look fine. Always separates, we know, custody of an asset like cash in this case from keeping the books or doing the accounting for the asset. Here we had that two steps, advice, and one checks in another. And of course, we hope that somebody in the mailroom ran a dash total on them. So they verified that the stacked remittance advices equal the stack of the checks that we. So we see remittance advice input. We also see something called a pre-listing of cash receipts. That's what happens when a customer does not include the remittance advice. There's the remittance advice. There's pre-listing of cash receipts in lieu of remittance advice. So there's that meal. Again, it's expensive. So what many companies do use, you may not even be aware that it's happening, is that they use the lockbox service. They let a bank or some other financial intermediary, but usually a bank, to worry about collecting the cash for them. So that's why down here it says many companies use a bank to process cash receipts from customers. Some companies use a lockbox system in which customers mail payments directly to an address maintained by the bank. The bank's responsible for opening all receipts, maintaining records of all customer payments received at the lockbox address, and depositing receipts, cash itself, into the company's bank account on a timely basis. So sure, all that grudge, you can have it done. You can have a lockbox system. It's going to cost you, but it could be a lot cheaper than having to have that dedicated secure mail room and you're always worrying about the employees in there. So a lockbox system can be good. Very much so, in fact, I should say. Well, then we see also a cash receipts transaction file. So cash receipts transaction file, well, that's like that sales transaction file. Here are the individual cash receipts kept track of by a relational database. Then whenever we would like to query that cash receipts transaction file, query our database, we can generate a cash receipts journal in traditional form because we're all familiar with that. It's just not the best way for a company to store its data. And one thing I should ask at this juncture, does everybody pay with a check or money order? No. Oh, by the way, most companies you could certainly pay using EBT. So, I'm sorry, EFT. So using electronic fund transfer, and it will take them around for a long time. So that's also a good alternative to a mail or to a lockbox service. We're certainly encouraged to pay things online as often as we can. Companies will say that that's saving us a scam, but we know the Romans, they save a lot. By the way, what is the price of a first class savings account? Just one. How much? 6. Yeah, it's 6. They don't have. Well, then another function here, processing, recording sales returns and allowances. Wow. We know the sales return is when someone physically returns the goods. Customer didn't like them or they were damaged or whatever. They decided they didn't want them anymore. But a sales allowance, there's no physical return of any merchandise. Instead, the customer was somewhat dissatisfied for some reason. Maybe the goods were late, or maybe some employee in the company was rude. Who knows? But the sales allowance is when the seller of those goods, excuse me, agrees to knock some money off. Now, which one is easier for the auditor to track? Would an auditor rather have a sales allowance or a sales return? Sales return, because you've got hard and fast inventory to latch onto. Yeah, but for sales returns and allowances, we see here a couple of things. We see a credit memo. Well, that is the document that is signed off on paper or approvals indicated online, electronic document. But that, excuse me, credit memo there is going to be run through the system. It is the authorization to deduct this money from the customer's account. I'm sorry, it is the internal document, pardon me, to add money to this customer's account. So we're crediting you for this payment you made. And then sales returns and allowances journal. If a company has a bunch of sales returns and allowances, it may want one of these. I'm sure Walmart has one, because how often is Walmart line full of people returning stuff? A lot, yeah. With Walmart, yeah, they're bound to have a sales returns and allowances journal. Now, I should ask, how careful would you have to be about internal control over credit? Very. They're like blank checks. So they need to be secure somehow. Yeah, just like blank checks. If they're paper form, obviously, very easy to see. In electronic form, they can be used there too. So you have to be really careful about authorizing these. So, Then those authorized credit memos get posted to the sales returns and allowances journal. You don't want to reduce accounts receivable balances unless you have to. That's cutting into your revenue, knocking it down. Well then, another function, writing off uncollectible accounts receivable. So we have a deadbeat. Now, every company should have a credit grading policy in its policies and procedures manual. Here's how we go about granting credit to both an individual and to that individual's should be careful there too. But for every single sale, which outright credit, be careful there. Otherwise, system, your bad debts are going to go up. So this writing off uncollectible accounts receivable. The problem is that if a fraud is committed, it could be by an employee too. What can happen is that if we don't have good segregation of duties, and by the way, authorization should always be a separate employee from anything else. If we allowed the same employee to serve as a salesperson, let's say, make some individual sales, and if we also authorize them to authorize these uncollectible accounts receivable, and they could keep the related books for these, you can see how they could embezzle through that tunnel of stuff. Not good. And then the uncollectible account authorization form. Well, it's an internal document. It says here that this company's authorized to deduct this much money, amount of dollars, from, shall we say, an internal fund of these. But I say that because they're being transferred over to customers. Now, if you're a deadbeat, is there a reward in the end? Yeah, there actually is. You guess where should I sit? You're not authorized for it. But within the system, we also do not want someone with lack of segregation of duties being able to prepare a phony write-up memo. So authorization for those must be very carefully restricted. Otherwise, they can prepare a phony write-up memo and run it through the system, and everything would look just fine. Sure don't want that. It's been used quite a bit, by the way, in employee frauds. Now, that would not be for a regular customer, but for a one-time only customer or some other irregular customer, it can happen. And then providing for bad debts. Well, there we are talking about increasing the allowance for bad debts and bad debts expense sufficiently enough. So the best way of doing this, of course, is the aging method. And we also have to be careful about changing economic conditions, because anytime economic conditions get worse, what do you think will happen to the customers, or rather to the company's bad debts expense? It'll go up. Yes, definitely. Don't worry about that whole lot. Whenever times start getting hard, a lot of companies fail to increase their bad debts expense as much as they should. So suddenly, their bad debts are running behind. Their allowance for uncollectible accounts is not big enough to meet these bad debts and start happening. Because anytime you have hard economic times, you'll have more bad debts. I say that especially now because U.S. is forecast to go into what? A recession, that's right. So whenever there's a recession, auditors will have a lot more time to spend going over with clients about how you should increase your bad debts expense and looking at individual accounts receivable with that customer, how they should be written off. Every company needs proper write-up procedures. So you'll let enough time go past, like 120 days, that's common, or 90 days. And if you exhaust the collections efforts to get the money out of the customer, you don't go to illegal collection efforts. You're not going to threaten or anything like that. But if you've exhausted legal means, it's time to write that account receivable on. The net realizable value of it is zero. Trillions. And that takes care of everything there in that section about walking through the sales and collection cycle. So I wanted to do that because I guarantee on the CPA exam, you'll have a lot of questions on the sales and collection cycle, including some from right here. Okay. Probably at least several. So those will be quick and easy points for you. Sales and collection cycle is not very difficult. So, no questions there so far. Okay. So, next thing we've got here. Internal controls and tests of transactions, meaning both test controls and substantive tests of transactions for sales. let me think about something here for a second. And if you're online, I'm going to go ahead and stop my share for a moment. Here we go. So I said here in this chapter when we first started it, that we're looking at individual transactions, whether to do test controls on them or substantive tests of transactions. So really, if we were to run things through accounts receivable, that would give us a good roadmap for the rest of this chapter and a good roadmap for chapter 16. Let me draw something up here with accounts receivable. I don't have a black marker. That's okay. See, that's good. Test out my other two, maybe a little squiggly line here. Well, that one's totally dried out. What should we do? You got it. Okay, I can't hit that can from over here. This. Oh, shoot. So close. Yes. That is a really good idea. We get some exercise too. Out the basketball court there it does. Good. Thank you. Yeah, once we get in practice doing that out there on the basketball court, I think that we're going to be able to intimidate those students from Southeastern. Mm-hmm. All right. Well, let's do a squiggly line like this. Last one. Oh my gosh. It's dead too.
Got it.
From here. Oh, close again. It's a warm. Good. Oh, that was really close again. See, these are harder than a basketball hoop because there's no. Yeah, backward. Yeah. With not this angle, otherwise I could use the wall as one. That was perfect time. Thanks. All right. So now let me redraw accounts receivable here. That doesn't look too good. If we just keep track of what's going into accounts receivable, it's going to make sense that we made some progress here in our discussion so far. Now, in accounts receivable, it's an asset and normal debit balance. We first have the beginning of the year balance. This beginning of the year balance is there because accounts receivable is a real account. Balance rolls over. When was it audited? End of last year. It was last year's ending balance. In fact, in accounts receivable, the debit we will have will be credit sales. Apologize, that's not the whole best marker. We'll have credit sales going into it. We'll talk more in just a few minutes about internal controls over those credit sales. then how the auditor tests those controls, and how the auditor does substantive tests of transactions. We'll then do the same thing over on the credit side that reduces accounts receivable for cash collections. Or cash receipts, if you prefer, to say collections. Same thing. That's what will happen. Customers will pay. But we will, in this case, also have some sales returns and allowances. We may also have some purchase discounts, terms like 210 net 30, especially in B2B accounts, business to business, not so much in B2C or business to consumer accounts. Pay early with cash, you get a 2% discount in most cases. And finally, write-offs of bad debts. Legible. So all those credits come out. We put this count at the end of the year. And we get the end of the year balance. So that end of the year balance, we're going to audit that during this year's audit. One of the biggest tests of details we'll be using that on that fact will be confirmations. More about that in the next chapter. Yes. Here they are online. There's the end of year balance. Once we get done with the debits and credits, that's all. So, what I would like to go to next here in chapter 14 will be credit savings. So again, let's talk about internal controls here and how we test those controls and how we do substantive test transactions over those credit sales. Go ahead and come back here. Share my screen with you. So the next part of the chapter here, from numeral 2, internal controls and test transactions for sales, credit sales specifically. And as we talked about test controls, as we talked about test of transactions, also known as dual purpose testing. If we do both the substantive test of those sales transactions and the test control. So we frequently do. So first of all, there are some basic concepts which should be present for all sales transactions. And some of these will sound very familiar from the first auditing course as general internal control activities we should follow. But we need to know for business, we need to know for the CPA exam as well. And after all, sales, that's the first thing on the income statement. It drives everything else on the income statement. Plus, in over 90% of accounting fraud cases, sales revenue was affected. It was manipulated by management. So some basic controls here. First of all, back in control activities, back in the first auditing course, we mentioned adequate documents and records. We always have those, so we can maintain an audit trail and follow what's going on. And we try to see if we can find anything wrong through them, because we can always trace that transaction from start to finish. So we see this permits internal control maintenance. In fact, we can document where we followed internal control at each step along the way, and also helps with financial statement preparation. Helps establish an audit trail again so that we can follow everything through. As test control, the auditor is going to ascertain whether employees follow document record procedures properly. Walkthroughs of transactions are very useful for doing so. Yeah, just like I mentioned here, that our auditors do. Caitlin, how many walkthroughs was it last year of individual student accounts? A whole bunch. Yeah. That means they take an account, in this case, student account, they go back to everything, all transactions going into that student account. They make sure the internal control is followed each step of the way. And the federal government requires that. We have to prove that we're doing our jobs and we're not misspending federal money. Well, then something else that will really help. Number 2, pre-number documents. Well, those pre-numbers will account for the sequence of documents. They will help both completeness to make sure every transaction is recorded in existence, so that no transaction is recorded more than once. As a test control, as well as a substantive test of transactions, so a dual purpose test, the auditor is going to account for the sequence personally. Note the client should do that also periodically, at least once a month, as internal verification. And pre-number documents also will help us with random sampling, as we'll see in a couple of weeks, because the pre-number uniquely identifies each document. We can have pre-numbered paper documents, by the way, like paper checks, or if we go into the electronic environment, again, paper documents, no problem. But in that case, we just have to be really careful to whom we grant access to the software that assigns pre-numbers. Because if we allow our operational people, let's keep the books, for example, to change pre-numbers, how big of a field day do you think they could have? There. Simply be going back and recreating their own documentation to justify whatever fraud they pulled off. Those uniquely identified documents. Now, number 3, we touched on this basic control activity. There should be periodic accounts receivable statements sent to customers, hopefully once a month. Again, customers will identify overstatements. They don't want to pay that much, but maybe not understatements. Again, they're thinking it's their lucky day. But we think about it. Of course, overstatements of accounts receivable is a riskier situation for the auditor, because in this case, that's exactly what management would like to do: overstate accounts receivable for obvious reasons. Well, by the way, accounts receivable statements, they should be prepared by the person keeping the related records, but when they come back from customers, if any differences have been disclosed, well, there should be an independent employee investigating that. A really good one is customer service manager. No conflicting duties. Keeping the books or authorizing anything else. Then, again, that's because that's type of authorization is test control. The auditor will observe and inquire as well as see how differences were resolved. So, no problem. Make sure the employees are doing their jobs. Well, then number 4, we always want proper authorization by hopefully some independent employee once again. So we've segregated duties. For credit sales, for shipments, for terms of sales, for returns, allowances, and accounts receivable write-offs. By the way, we can note that credit and term authorization may be on it. Yeah, very much so. As test control, the auditor is going to look for evidence of the authorization, such as a credit approval number. Or if it's not in an electronic environment, someone's initials on a document. Now, a little bit more about segregation of duties here, number 5. Well, we especially need to segregate cash handling from record keeping. So custody of cash separated from record keeping. Otherwise, somebody could steal some cash and cover it up in the books. And also need to separate all that from credit grant, from granting sales returns and allowances, and also granting accounts receivable write-offs. So yeah, we allowed somebody to authorize accounts receivable write-offs, and that person is also in charge of being a cashier, getting money from customers of some capacity. Pocket some of that money from employees and trust those, well, in this case, getting money, I should say, pardon me, from customers, and then keeping that money, like covering it up by preparing a employee line. Again, like a blank check. Again, that's been done a lot of times in business. Now, we separate credit granting from sales in number 2. Now, I know it may seem as though someone selling goods or services is granting credit to you as well, but they're actually not. That's credit. These states are probably getting authorization manually over a computer. But again, the credit department is in the end for doing so. So if we think about that, here's general is authorizing credit, but still, that's not entirely an artificial person. So we would never, for example, want our salespeople to be directly granting credit. I know it may look like it, but the computer is actually doing it on behalf of the credit department. If we allowed our salespeople, by the way, to directly grant credit for purchases, how many customers are going to be receiving credit? Yeah, what's that down to commissions? Then, number 3, separate all the above from internal verification. You may recall the internal verification in the first auditing course is where somebody checks over everything else that was done. That somebody should always be independent of the other employees. Because if we allowed an employee to, let's say, check over the accounts receivable aged trial balance they've just prepared, they probably won't see their own errors, even if they are incredibly honest. So hopefully somebody else is doing that. Well, then B, rather just under number 3, as a test control, the auditor will observe, inquire, and verify that those are separate on the organizational chart, also separate in job descriptions and or in the client's policies and procedures manual. So it's pretty easy to make sure they really are. Then number 6, we should also have internal verification of everything possible. So all the functions which should take place. And of course, internal verification must be done by an independent person. Again, otherwise nothing would ever be disclosed as wrong. As test control, the auditor is going to look for evidence of internal verification, such as initials on a paper document or a log for an electronic document. Now, in B, I've got the table 14 shows that does an excellent job of walking through things down by transaction-related audit objectives. I found that that table isn't bad for students to go through. You just need to read through it. If you have any questions, you just let me know. I guarantee that table is going to feature a lot of CPA exam questions coming directly from this material. Guaranteed. So that's a good kind of summary of a lot of the stuff that was talked about in the chapter. So then looking at C, actually, that does it here for credit savings. But here in C, this is thrown in. Sales returns and allowances. They were just looking for home, I guess, for it. But in C, the auditor says of sales returns and allowances are primarily concerned with existence. So the auditor wants to make sure these transactions was properly authorized and so that no cash was diverted through embezzlement. And consequently, he or she also looks for proper segregation of duties here. Again, we want someone independently being able to do this, and certainly not someone who has access to cash receipts. Otherwise, it's really nice to prepare a phony credit memo, run it through the system, everything looks good, and then they take that much money, they embezzle. Not good to do ample. It's been done in a number of businesses. Okay, good. Done with sales returns and allowances. Again, any questions so far? Don't worry, chapter 14 is by far the longest of any of these three chapters. But it, like I said, really takes you through the paces very well. And you'll get a lot of benefit on the CPA exam if you study it thoroughly. So now Roman numeral 3, internal controls and test transactions for cash receipts. So we'll go through some things here. So cash collections, also known as cash receipts. Let's see some things. Now, here in A, we bear in mind that the client has the bias to overstate cash receipts. Management certainly does. Trying to overstate cash receipts, obviously pumping up the balance of cash fraudulently. So management fraud, overstaying cash. However, employee fraud, that which a lower level employee has motivation to do. Well, they're more concerned about this. They want some cash, so they're trying to steal it. So, thus the audit is concerned with both existence and completeness, respectively. Existence, like with management fraud, overstaying cash. However, completeness was stealing individual currency. Individual cash drawer, for example. Well, we see there that obviously cash has very high inherent risk. So the client should have good internal control over cash. High inherent risk is moderated by low control risk in the denomination of the risk model. And that means the product of the two is risk material misstatement. We want that to be as low as possible. Well, not surprising, the auditor will spend much audit time performing tests related to cash. And in B, cash theft is always most difficult to detect if it's hidden excuse me, hidden from view of the company. In other words, if it is stolen before it's ever recorded, then there's nothing there, no audit trail to trace it back to. That's why we try to get cash receipts in the mailroom as soon as possible. Not enough time for someone else to steal them. Theft cash, very difficult to detect, stolen before it's recorded, just nothing there to trace back to. Well, therefore, the cash collection point, well, that could be the cash register, or it could be a mailroom. It's always a potential source of trouble. And possible internal controls to help include finding employees, doing background checks to ensure trustworthy employees, observing employees, remittance devices, using remittance devices for mail payments, and also requiring cash customers to obtain a receipt. Yeah, cash customer get a receipt. If you don't get one, you'll get some little reward. I think Bed Bath & Beyond $5. At least it used to. Has anyone been in a Bed Bath & Beyond store lately? How's it looking? Okay. So no big thrill to go in. Yeah, I think they give you like $5, $10, something like that. Or in the case of Publix, there's the Publix guarantee. And what's that? They're getting you to police internal control over pricing. Remember Publix, if the item is mispriced, you get 1 unit of that item for free. So again, trying to get you to police, in this case, internal control over pricing. But yeah, situations where employees simply pocket cash receipts. One of the biggest places for this to occur is in bars. Wow. Is there any really easy way of tracking how many drinks were sold? I know it should be done on the cash register, but a lot of people are, it's called sweetheart too, especially if the server's trying to max down tips. So suddenly you get around free drinks. Trying to get you to ante up more in the end. But in bars, theft is notorious of both cash and of alcohol. It's expensive stuff. Then, something that has to do with cash receipts is called lapping. And lapping, I'll tell you what it is. It involves stealing a cash receipt and using a layer cash receipt to credit the first customer's account. You can do that. There's core segregation of duties between custody of cash and record keeping. So you simply delay the length of time to record that customer's account receipt. And it's really difficult to detect. So we just keep trading one account for another, if you will. Use a layer or the amount of cash you receive layer for another account to again credit the first customer's account. You can lap for more than 1 day or for more than one customer. It can really add up. Banks are concerned because it's a way of getting an interest-free loan from them. So with this lapping, it tends to be an ongoing process and it's really hard to detect. Well, segregation of duties between custody of cash receipts and accounts receivable record keeping will prevent it unless there's some collusion there between the two. And also, forced vacations and rotation of duties will help break the cycle. And to detect lapping, the auditor would have to determine the date of an individual cash receipt, cash collection, same thing, and whether we can trace it back to the cash receipts journal and to the book or to the bank deposit, the bank record, to see if there are discrepancies in dates. Lapping, it doesn't involve much extra time generally, but if you can come up with some waiting time to get credited for a check, that can be a sign of lapping. If suddenly we're just not getting credit checks as quickly as we used to. But yeah, lapping is something that was addressed by the Federal Reserve System. And I think it was 2000, yeah, in 2004. Check 2004. Checking for the 21st century that was passed in. That is the one that shrank down the amount of space on the back of the check the one has to sign. Because if one of the rest of the check to go through the Federal Reserve System in a very quick way of time, so that the books are up to date, they didn't have employees complaining about, oh my gosh, my check's late. It is every month. It's type of lapping as well. Now, indeed, here's another little tip. Not every company follows it, but they should. Well, the client should deposit all cash intact daily to establish a neat audit trail and to try not to feel loss. Oh, oops, I'm sorry. What missed that? Forgot something in the first sentence. Okay, this client should deposit all cash intact. Now, when I say to maintain an audit trail, let's say that there happens to be $7,000 in cash that was received in all cash register sword circuit. We should find $7,000 on deposit with the bank for one to see it documents that. Accounts should not start paying little expenditures during the day out of cash register. They just shouldn't off that day's funds. Instead, deposit those funds in the bank intact at the end of the day. Then if you want, you can order something for this installment / family member. So you can do that out of something which you've heard of called petty cash fund. So yeah, petty cash fund should be separate. That way you run all these expenses through it and you've controlled the amount of money that can be spent on those expenses. Now, in E, there's another table, but we don't really need to go through it. You can do that on your own when you have a chance. Okay. Well, that takes care there of all the cash collections. We've done accounts receivable. We've done sales returns on allowances. And next thing we're going to do here on collectible accounts receivable, also known as write-offs of bad debts. Because in life, well, let me bring you back here if you're online. Let's stop share. Okay, there we go. Okay. Writing up bad debts, just to talk a little bit more about those than we did. So these audit tests for uncollectible accounts receivable. So yeah, periodic periodically in life, we do run in, oh, what the heck? Sorry, that, okay. Sometimes here in life, yeah, we run into deadbeats. So we have deadbeats here. Their accounts are uncollectible. We've been through normal collections efforts, try to convince them to pay, and doing so legally. But if we've gone through all those collections efforts, a certain minimum amount of time has gone by, 90 days, 120 days, up to them to decide, it's time to write it off. We're not going here. If we allow an uncollectible account receivable to stay on the books, it looks like we're not doing a good job. It looks that way because we just let that go. It's going to look like we were lazy and actually didn't try to track down payment from someone. So looking here, we said the write-off memos are like blank checks. So sure enough, the auditor is most concerned with existence and authorizations. So those two audit objectives. Here's one. Concerned that an account receivable may be written off to cover up theft by an employee. Thus, the customer would pay, but an employee would pocket the money and prepare a write-off memo to credit the customer's account. And that would only occur if duties were not properly segregated, or if there were collusion between employees. That can happen too. So sure enough, one employee does one thing, another employee does something else, but they're friends, they get together, work together, and they split the proceeds, like somebody having custody of cash with someone who can prepare write-off memos. Combine the two and they can have all kinds of fun. Make all kinds of money. Well, then in B, audit test for accounts receivable. That would be. Audit tests for uncollectible accounts receivable involve reviewing write-off procedures, excuse me, looking for proper authorization, segregation of duties, also examining reasons why individual accounts were written off. Obviously, that should be documented like anything else in business. And also tracing a sample of write-off memos to accounts receivable to make sure they were properly recorded. Then C, the auditor is going to review all the client's age trial balances of accounts receivable to determine the appropriate balance, the allowance for uncollectible accounts. Generally, the client should have at least 12 of these on hand. Should do at least once per month. Well, in doing so, the auditor is going to evaluate whether the estimated percentages of uncollectibility are reasonable or not. You know, to do a trial balance, each trial balance, that is, of accounts receivable, you had those estimated percentages of uncollectability. Say that 3 times fast. Keep on for quite a while. But clients tend to understate it. They don't like to admit to as much that debt expense as they really can. Like I said, especially during hard economic times like a recession, investors still just don't increase those estimated percentages of uncollectability as much as they should, even though they get more. It's kind of a convenient thing to forget to do. In my terms. All right, that takes care of chapter 14 there. Any questions on chapter 14? Like I said, it's by far the longest chapter that out of the 3. Pretty basic by now. Okay, I was thrown into an AIS as well, although from a different angle. You should do really well in that part of the CPA exam, especially once we covered 16 and 23. Well, let's look down here at chapter 23. And for those of you online, there's the handout. And I'm going to go ahead and share my screen here with you. Or actually, just before I do, for those of you online, if I look up here, and I remember that we also have to test the end of year balance and accounts receivable, which is going to roll over next year and become its beginning of the year balance. So we're concerned that that end of the year balance is quite accurate when it comes to accounts receivable. We'll bear that here in mind. To audit the ending accounts receivable balance, we're going to rely on test of details. Again, the primary test of detail will be confirmations of accounts receivable. Okay, exit that. So thinking about audit tests here in this chapter for accounts receivable, well, tests of controls and substantive test transactions are the same as for the sales and collection cycle. We just covered that. Analytic procedures, not much. Well, coming on down to tests of details, which is really what we're trying to examine primarily in the chapter. Well, tests of details for accounts receivable are still necessary, even if the results of earlier audit tests were okay. For example, good substantive test transactions or the sales and collection cycle can never eliminate tests of details for accounts receivable, but may be able to reduce them somewhat. We'll consider tests of details which pertain to each balance-related audit objective, since we're looking at any balances in accounts. You don't remember what the balance-related audit objectives back in auditing one were at this juncture. You're okay. So tests of details for the ending balance, like confirmations of accounts receivable. So let's consider some common tests of details, again, pertain to each balance-related audit objective. Well, first of all, detail tie-in audit objective. You may recall that back in auditing one, it just made sure the books balance. For example, the total of the accounts receivable control account, we can match up to the sum of the individual trial balance of the accounts receivable. Two totals match up. That's detail time. So as I mentioned here, an aged trial balance of accounts receivable should be performed and should be compared to the control account total. And if the client has already performed it, let's hope they did. The aged trial balance, if they did it, the auditor can simply reperform it, make sure it's okay. And some accounts receivable should also be traced back to scoring documents to see if transactions were posted to the proper customer's account. Because quite frankly, well, posting errors occur there sometimes. Now, with the next one, number 2 is existence. Again, we've seen today that existence means no overstatements. So preventing that here. Existence, well, focuses on overstatements of accounts receivable. That is certainly a major concern of the auditor. And confirmations will help there. That matters. So do those monthly statements of accounts receivable balances sent to customers. Because we know for all this, the customers are going to tell us about overstatements. This company's trying to bill me too much, but understatements, that's a happy day. They won't say anything. Now, I've had some students ask, who insisted they would say something. I think they were just trying to impress all of us with their good old dash and honest principles, right? Yeah, get my drift. And by the way, I need to share this with you if you're online. I apologize. There we go. So this exists again, focusing on overstatements of accounts receivable. We're saying there are none, hopefully, which is a major concern of the auditor. Again, confirmations will help there because we know that if existence has been violated, that individual customer's account receivable has been overstated, and they'll let us understand. No, lucky day. So number 3 is completeness, the exact opposite. Completeness means no understatements. So that focuses on understatements of the accounts, and well, here with accounts receivable, not a particularly risky situation for the auditor. They're understated, maybe kind of so what, those accounts are understated. Any other assets understated, maybe that's like a little bit of insurance. And also management's bias, as we know, is to overstate accounts receivable, not understate. When completeness is primarily met through substantive test transactions, just tracing them all to the account, the customer's account balance. By the way, confirmations will be limited use. For example, if an account receivable is omitted from the client's ledger, that's one way completeness can be violated. If it's been omitted entirely, there's just nothing there to see. We may not be very likely to find that. So it's omitted from the client's ledger, the auditor is not going to have anything to confirm. Because that list for confirmation is drawn from the client's ledger. And further, if an account receivable which is confirmed is understated, that customer is going to remain silent about the matter. Again, our lucky day. Hey, they think we owe a lot less than what they really do. When, or the company rather, thinks that business owes a lot less than what that business actually does. Okay. Then number 4, rights and obligations. Now this objective means that somebody around here is owning at least some stock for a plane. So, excuse me. Well, again, usually the only problem here may be factoring. And factoring, you may recall, is where those accounts receivable are sold to a factor. A lot of banks are factors. They'll give you money up front, albeit at a discount, but you no longer own them. They'll collect them too. So factored accounts, when it comes to rights to those accounts, does the company own them anymore? The answer is no. That was just to drive that home there. So factoring that should have been disclosed through such means as inquiry, review of board of director minutes, also review of large legal cash collections. Hopefully they're legal. By the way, the factoring arrangement should also, excuse me, should also be confirmed with the factor, not with individual customers, because individual customers probably don't even know their account's been factored. Now, accounts receivable, also mortgages and student loans are all sometimes factored. And note there's no problem if a client's accounts payable are factored, downside the coin. And that's because these are going to be, excuse me, these are still going to be owed by the client. Well, then, are the right amount of dollars there? Number 5, accuracy. Well, confirmations will help with the valuation of gross accounts receivable. The age trial balance helps with the balance of the allowance for bad debts. So gross accounts receivable minus the allowance for bad debts is the realizable value of accounts receivable, and that's how much cash you can think you'll get. So the allowance for bad debts is bringing down the total balance of accounts receivable, which has been a big thing for attorneys to go through. Think, oh, people must be taller. No. So in this case, gross accounts receivable. Well, deduct the allowance for bad debts, and then you have the valuation or amount of money you're thinking you can get. Net realizable value of accounts receivable. So the age trial balance help with the allowance for bad debts, and the owner should again be careful to review the percentages of those estimated uncollectabilities. Make sure they're realistic. I guarantee, like I said, pretty darn soon, auditors are going to have to contend with that a lot. Sometimes they'll get into some disagreements with the client because the client just doesn't want to do that. They don't like to admit to bad debts, as we know. Now, number 6, classification. Usually not much of a problem. Just means we properly classify accounts receivable as usually a current asset. So the auditor should make sure if there are any separate classifications, like related party accounts receivable and long-term accounts receivable, that those are classified separately if needed. And also significant credit balances should be reclassified as a current liability, because technically we owe that back to the customer. And further, notes receivable are sometimes misclassified as accounts receivable. That's actually common. Someone doesn't know the difference between note receivable and account receivable. Something to always look out in the audit. Well, then number 8, presentation and disclosure. The objective. This involves seeing that the individual classifications are properly disclosed in the financials and the footnote disclosure is adequate. Footnote disclosure, that's usually where you might run into a problem. Something the client doesn't like disclosing. They're hoping that you won't catch them on. For example, if bad debts expense went way up this year, it should be really spelled out in a footnote. Interested parties are going to want to know. The clients don't like doing that. They hope they can get by without disclosing, kind of like a child. Well, then number 8, cutoff. Just mentioned a little bit ago that right around year end, we must record every transaction in the exact year in which it takes place. Otherwise, we've got trouble. So cutoff, again, involving making sure the transactions are recorded in the proper year. The auditor is also going to determine whether the client has sufficient credit procedures, sufficient call procedures. Again, to employees, say stop, look, and listen right before and right after fiscal year end. Make sure you post every transaction the actual year it took place. And by the way, the auditor is also going to take a sample of transactions, at least above a set threshold amount, occurring just before and just after fiscal year end. Test code for these things. One is for sales. Well, sales should be recorded in the year in which the tile passes, determined by FOB terms. So it's FOB shipping point, most common. Tile passes when that inventory is shipped. FOB shipping point, it passes later, once it arrives to the customer. So, and you should make sure we record on that same date. Well, quite frankly, we can note that clients will have more common procedures or FOB destination. They'll tend to treat them as FOB shipping point. Well, won't make a difference in the middle of the year, but will at year end. That's where you're really careful. So clients will tend to treat them as FOB shipping point, again, recording it early. And that would not make a difference in the middle of the year, but will fiscal year end. Well, then B, sales returns and allowances, something else for cutoff. Well, preferably, they should be recorded the same year as the sale, due to the matching principle. Now, in practice, though, sales returns and allowances are usually recorded when granted, however. And thus, the auditor normally worries only about call for very large sales returns and allowances. And also, well, any expenses that are related to a sale, such as commissions, should be recorded in the same year as the sale. That's part of the matching principle too. So just match all those things up. Then C, cash collections. They should be recorded in the year in which received. So you can think of ownership of cash as FOB destination. But sometimes clients want to step up those cash collections from the early part of January to the very last part of December. They may even save the envelope for you and see, I should get to record those last month in December, not this year in January, even though I just received them in January. Of course, they're trying to argue that way because they want that last extra shot cash in at year end. Again, just worry about only the big ones here. And also all expense related to a sale, like commissions, should be recorded in the same year as the sale took place. Cash collections, again, recorded in the year in which received, not before. The clients will tend to try to do that. Now, number 9, realizable value. That means not overstaying something. In this case, valuing accounts receivable at only the amount you think you can get out of them if you collect total 100% money from all the from all of the customers. Well, at least customers who aren't deadbeats. So with realizable value, it involves writing off uncollectible accounts receivable, individual receivable. That was too bad. And by the way, those might be uncovered through confirmations and also evaluating the allowance for bad debts. Well, I say that an uncollectible accounts receivable might be revealed through confirmations because maybe that customer moved and left a forwarding address. And that's usually a sure sign, unless you track them down, that you're not going to be able to get the money for this account receivable. How many people do you think move as a way to try to avoid that? They do. And it used to be even easier in the past when they weren't as easy to track down because technology, lack thereof. Well, then another activity the auditor is going to perform is evaluating the client's credit granting and collections procedures. The auditor wants to see procedures in place which will minimize bad debts. And if the client's procedures are lax, the auditor is going to expect a lot more bad debts. Will increase confirmations because you've let more deadbeats in the system. And the auditor may also recommend the client increase the percentage of bad debts on the age trial balance because, again, they've got problems. So we'll go through confirmations here next. Confirmations definitely aren't very bad. Any questions so far? So confirmations, that is the major test of D2 for accounts receivable. Test of detail, as we know, looks at the ending balance and make sure that it's accurate. This case will send this special statement out to individual consumers, return this directly to the auditor. Is your account balance right or wrong? If wrong, client's got some problems. So here it is. We're told that we must do confirmations unless one or more of the following conditions exists. First of all, if accounts receivable are immaterial, then obviously we don't have to bother. It can't happen that accounts receivable are immaterial because for each sale, instead of when one runs his credit card, instead of an account receivable which remains on the books as the client's property, instead what happens? The client doesn't even have to enter an account receivable on the books. They never even own one. Because that night, after all the sales have been made, and they work at traditional day, they cash those sales out and keep that monthly sure it's okay. And then they transfer to whoever their processor is. The processor fairly quickly is going to send them cash and of course refuse anything there in the way of something physical. So immaterial, not big enough to worry about. And again, that happens a lot with credit cards. If they're using external credit cards instead of their own accounts receivable. Now, number 2. Also, this can happen, no confirmations required. That is, if the auditor considers confirmations to be ineffective evidence because response rates likely will be inadequate or unreliable. So again, you'd rather confirm B2B or business to business accounts receivable. Businesses probably care, they want to return these, they want them to be accurate too. And they keep their own books so they know how much the balance should be. But an individual consumer in B2C, this is consumer accounts receivable, they probably don't do that, to be honest with you. And they don't know how much the balance is, they look it up. So simply shove back at you what you already knew is on it. Well then, number 3, this can happen too. The risk of material misstatement, which back in the audit risk model was combined level of inherent risk and control risk. It's low, that's good. And other substantive evidence can be accumulated to provide sufficient evidence. And such other substantive evidence is often termed alternative procedures. By the way, the best alternative procedure there is subsequent cash collection of account receivable. Otherwise, the auditor is going to have, is probably not going to be satisfied and would have a scope limitation there because you didn't confirm accounts receivable if they needed to be. So if you have a really good client, and especially if accounts receivable aren't that big, if their risk material misstatement of those accounts is really low, you might be able to let some things slide a little bit there. In this case, not confirm accounts receivable. And if you don't confirm accounts receivable, you save that client a lot of money because confirmations do tend to get expensive. Now in B, confirmations should still be done if good results are obtained through substantive test transactions pertaining to sales and collections, although confirmations be reduced in that case. You don't have to confirm as many customers. Again, it saves money. Well, confirmations are best for these things. Uncovering invalid accounts receivable or fictitious customers. Somebody's trying to pull the wool over our eyes. In this case, and they've set up a phony account in most cases. That's an invalid account, a phony. The company being audited could have also done that. It's happened. So, uncovering invalid accounts receivable, fictitious customers. No such customer there. The confirmation comes back stamped by the post office that there is no such customer. Probably going to have to write it off. Also for disputed amounts. So a disputed amount. The business says this customer owes $1,500. Customer says, no, I only owe $1,300. A $200 discrepancy. Okay, that's big enough to worry about, definitely. So that's a disputed amount. Of course, the customer always says, we owe less. We owe less than what the company says on their books. Again, we've lucked out. It wouldn't be the opposite way around. Do you think it's a good business practice if the customer complains to allow this complaint to go on and for suddenly, well, a bunch of customers are really dissatisfied. They say to the auditor, this company did not bother settling up my complaint. I really owed less than what they were billing me for. That's bad customer service. That's disputed amount. Also, debtors who moved and left no forwarding address. Those come back, stamped by the post office, addressee moved, left no forwarding address. Also, we bear in mind the confirmations from business customers are usually more reliable than confirmation from individual customers. Again, B2B versus B2C. We like B2B. Now, in C, confirmations can be done of the ending account balance, or we could even confirm individual transactions. We just give them a list of transactions. Please confirm these for us, the auditor says. But if we think about it, the latter is often easier for clients because they're so used to reporting and paying individual transactions. So it can be rather like, in this case, excuse me, it's rather like a monthly statement sent to customers. In this case, 12 months. So please look over this. Our client who sold you something is needing to know this information. So are we as an auditor. It would help you out. It would help us out a lot if we don't just confirm the final ending balance. We would love to give you more information here and go through it with us. Higher information value then. Now, reading on, in fact, if the former is not used, in other words, just confirming the ending balance, the auditor may increase confirmation rates by including details of the account balance with confirmation report. And such details may include invoices and other documentation. So again, please check over all this for us. Make sure it's accurate. So that gives you a lot more information than just the final balance. That's good. Now, indeed, confirmations can be positive or they can be negative. Let me go into the book. We'll just see the difference. 539. page here. Sometimes, again, the printed version and the online version are off slightly in page numbers. Okay, I don't have my actual book in front of me here, but I'll tell you, if you look sometime at home, you'll find that in these two forms of confirmations, a negative confirmation request does include the balance. It must, because the customer is to return only if something is wrong. However, the positive form of a confirmation request means the customer must return no matter if the amount shown on there is right or if it's wrong. More expensive, but gives you better information value. And if an individual customer does not go out, you'll know, and then you'll contact them again. Whereas, a negative confirmation request only return if it's wrong. What do you think a lot of customers are really doing, especially a lot of individual customers? Yeah, they'll trash it someplace. I don't want to bother with that. So, as we see here in number 1, that customer is instructed to return a positive confirmation, no matter if the amount shown on it is right or wrong. While negative confirmations are returned only if the amount shown is wrong. Well, positive confirmations are thus more reliable, but more costly. And they should be sent to accounts receivable with high relative risk of misstatement, such as related party accounts or accounts which may be wrong or in dispute, or to customers who may not give negative confirmation requests sufficient consideration, just like discarding that negative confirmation request without looking at it. Regulatory agencies may also require certain confirmations which need to be positive. Oops. For example, here in Florida, construction companies are regulated by the state. Well, a lot of their accounts receivable, the state says, we must have positive confirmation requests sent to those people. Reason is the state wants to see more about people's feet than left. So, okay. So, okay, now, by the way, how many people have been ripped off by construction companies in Florida? Exactly. You know why? A lot of positive confirmations are required. Yes. Because leading on one's feet and marching out, that's exactly what a whole lot of unscrupulous developers have done in Florida over the years. Yep, they just suddenly vanish off in the sunset. Well, moving on to number 2. Normally, accounts receivable are stratified according to the risk material misstatement. So accounts receivable with high risk of material misstatement are sent positive confirmations. They're worth it. A sample of accounts receivable with low risk material misstatement are sent negative confirmations. Well, now note the part stratifying by risk of material misstatement involves stratifying by size. Thus, a high percentage of accounts with very large balances could be confirmed positively. Again, they're worth it. And an even lower percentage of smaller accounts could be confirmed negatively. And for even smaller accounts, including those with a 0 balance, maybe a credit balance too, few if any confirmations may be sent. Again, they just aren't. The really small ones, the 0 balances, Auditors usually stratify those out and send no confirmations to them. Now, by the way, in E, clients often prepare confirmations because confirmations merely list the balances of the accounts receivable as shown on the client's books. But the auditor must check the confirmations before mailing them, of course, make sure they're okay. And the auditor should also mail confirmations outside the client's office. Because if we don't, what could that client do? Look through them. Pull out the bad ones. Mail them to the post office. So the auditor's return address should appear on the outside of the envelope's return address. So if something's wrong, like the addressee moved left or forwarding address, this envelope comes back to the auditor, not to the client. Client might just shred because they know there's a problem. Also, the confirmation should be returned directly to the auditor. Best thing to do is to place an envelope in there, pre-addressed, and postage paid. Real good way to get your confirmation rates up. Well, F, as we said earlier, confirmations probably will not detect understated accounts receivable because customers are going to remain silent. Again, their lucky day. However, if the auditor suspects an account receivable is understated, he or she should send that customer a positive confirmation with the amount omitted. This way, they've got to fill in the amount the customer must. Customer then has to complete the amount. That's often known as a blank form confirmation report. Now, G. Confirmations are traditionally done as of fiscal year end. However, if the auditor is getting busy, then the auditor might be able to move these up to an interim date. So instead of confirming them as of December 31st, fiscal year end, confirm them as of Halloween, which is coming right up here. And then for a good client, that 2-month interlude doesn't matter. If they've got great internal control, it'll still be great 2 months from now. Just a good way to balance out our own workload. So that's why I say in the second sentence, however, if internal control is good, confirmations can be moved up to that interim date, like October 31st, and the auditor can then perform some substantive tests of transactions and some analytical procedures to evaluate the period between the interim date and fiscal year end to make sure everything is still okay. Yeah. And to make sure there have been no changes in internal control. We can remember that in order to do that, the client must have good internal control. It's got to be a good client, therefore low control risk, as well as low risk of material misstatement. And, excuse me. Also a decrease in acceptable audit risk. That's a chance we take of issuing the wrong type of audit report. If that goes up, we've got to gather more evidence. We have to be more careful. Or a decrease in the amount of considered material. It could be addressed by the auditors modifying the audit plan by applying audit procedures closer to year end. So the worst, if you will, the client is we must perform confirmation closer to fiscal year end. The better the client is, the more likely we are to move those confirmations up to an interim date when we're not as busy. And we might even give the client a little bit of price break. The PA firms often do. The reward for being good clients. Now, then H. Follow-up procedures. The required when. Well, first of all, when a positive confirmation is not returned, the auditor normally contacts the customer to obtain an answer because the customer is supposed to return it. So what's going on? Now, if this is not successful, the auditor is normally going to be satisfied if he or she sees that the account receivable is paid after fiscal year end. It's called subsequent cash collection. After all, why would a customer pay the account receivable if he or she didn't know it? Outside parties just don't do that. So if there's an account receivable on the books as of December 31st for $5,000, we can't get a confirmation, a positive confirmation to be returned by this customer to the airline. Well, if the customer pays off in January, we have subsequent cash collection. That customer has in fact admitted to that's how much they. It's a really good alternative procedure, as we call that. So if at first we couldn't get information the way we wanted, get some in some other fashion. Now, in number 2, also follow up with a confirmation is returned by the post office because customer moved and left no forwarding address. Normally, the account receivable here will have to be written off. Same thing for an invalid address, which may also indicate management fraud. Yeah, that can be a good way to generate some employee accounts receivable. Now, number 3, also follow up when the customer disclosed the difference. The most common cause is because customer paid the account before fiscal year end, but the client did not receive the payment until after fiscal year end. Obviously, everything's okay here, but trust me, a lot of customers still want to let you know. Well, other duties or other differences rather may be due to disputed amounts. So again, client says the customer owes more than what the customer thinks. So material disputed amounts must be solved before the end of field work. It's scope limitation otherwise. Well, many disputed amounts are because customer never received the goods, or the goods were returned or they were damaged. And still other differences may be due to client error. And the auditor may also need to reconstruct the account receivable by tracing back to supporting documentation. And that will take a while. Any questions? By the way, I said how the confirmations must be mailed outside the client office. Well, this was over 10 years ago now. There was an investor in Naples who started operating a Ponzi scheme. Anybody know what a Ponzi scheme is? Yeah, okay. In this case, if you want to invest in his, I don't want to say mutual fund, but in his investment account, shall we say, that was investing in real estate. If you would like to get a piece of the pie, well, invest some money with me. And for a while, he was showing wonderful dividends to me. Of course, he encouraged them to go out and recruit too. Where do you think these big dividends came from? Exactly. Yeah, he was using the later customers' money to give the more long-standing customers these nice big dividends. So they were really recurring right left for him. But eventually, all Ponzi schemes that fell apart because it couldn't continue doing it. But about the time things were getting tight, it was all at time. So, well, the auditor had prepared confirmation requests to these individual investors. Is this your balance? Is this how much you're actually receiving in the way of dividends, etc.? Well, this guy knew that if these actually went out to individual investors, he was going to be found out. Well, what happened was that the auditor actually put them in the outgoing mail basket. It was sitting there on the receptionist's desk, and the receptionist said, "Oh, the mail is going out soon." Well, this got overheard. So he went and took almost all of the confirmation requests out of the basket there. And overnight, he, his wife, and her sister-in-law. Oh, I'm sorry, that was his girlfriend. He was divorced. Now I remember. And of course, the second wife, she was a trophy wife. Yeah. And he was treating her well. Another reason he needed this money. So this girlfriend and girlfriend's sister, they spent one night after they gathered these up, just trying to bury their rhyme. And they answered all these, and they mailed them from post offices all around the area. Naples, Benini, Fort Myers, I think they went to Fort Charles. So it looked like they were coming from all these different individuals. Well, sure enough, the owner was satisfied. But pretty soon, the whole Ponzi scheme just simply crashed down. Well, he was imprisoned. The girlfriend was in prison for a little bit. And as far as her sister, she didn't get much, I think just some probation. But they had that perfect opportunity there. He grabbed it. So the owner was so careless to put those envelopes for the taxes. Never, ever, ever do that. So I'm sure after that, the girlfriend left him, don't you think? I'm sure. Well, I will save chapter 23 until 2 weeks from today. It's not a very complicated chapter. It's a lot shorter than one of these. And I don't even cover the whole chapter. So go ahead and do the homework from chapter 14 and chapter 16. And on my accounting lab, I will push back the due date for chapter 23 accordingly. Okay, that balances your workload even better. And after all, coming back to fall break, especially since it's been 3 weeks since we saw each other, it's kind of like another startup. Well, have a great one, and I'll see you back in 2 weeks. Bye. Gosh, difficult to think that 2022 is almost. I'm sure flying. Okay. No. Yeah, so.
It's full-time during tax. So I was wondering if since if that would qualify as long as 4 hours, not 2. I asked, she asked.
Yes.
Okay. Because I know that there's a threshold of hours worked. Equates to hours. But I figured, full-time tax season is like 60 hours a week for 16 weeks. So, all right.
The only thing though is that for CPA players in accounting, you can only use 3 hours in church at present. So the 4th hour, it's fine. It would just be counted as general businesses.
Right. That should still work out fine. I think I have an order. So it's just more about my 12 hours to be full time. All right. Thank you so much.
Sure, anytime. Take care of it all. Oh, so you don't have to buy. Number 14. tuition. What they essentially do is very indirect. Yes. So she took your tuition essentially and so. Sure, anytime. You too. Feel it.
Thank you.
Thanks. Have a great day. Bye, Paul. Thanks. Have a good day.
That's the thing.
They must have been.
Yeah, that's the thing. Yeah, good.
You too. I thought. I got a chance, period. How's your work going for you? Question.